Okay, folks, welcome to State of the Market. I am David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone. We do these on Tuesday afternoons. Going forward, we're going to do them at 2 p.m. And just look at some important weekly sort of levels on the indexes, the big sector funds, and things like that. So I hope it's going well for everyone today. Um, and just showing you some disclosures to begin. I also am going to share in the chat some just other disclosure information. We are going to be looking at ETFs, so just so you know, we have a link here to the prospectuses we're about to share. And also, if you go here at tradestation.com, it's in one of these disclosures right here. We actually show, if you're interested, tradestation.com/insight/ETF disclosures. We're going to show you the standardized returns. Remember, we use these indexes. We use the ETFs as like, essentially as convenient indexes on things like, sectors and stuff. None of these things are not, any kind of trade recommendations, anything like that. We're looking at areas of strength in the market, and those the spider funds and some of the others we look at are especially useful for that. So now you can look here at these standardized returns, and there's a lot of interesting things happening today. I'll just tell you that. And in some ways, one of the most important things is actually not on this list, and it's the dollar index. And I normally do not talk with the dollar index, but I feel like right now we actually, I wanted to begin by looking at the dollar index. So I'm going to just quickly jump over here now and show you a couple of charts. First, actually, put up Charles Dow first, actually, because it's funny. He's famous for looking at the transports as an indicator. And what's interesting now is the transports had a really strong week last week. They had their best week in a while. Let's see. I'm trying to actually. I had a note somewhere. If you looked at the transportation index, had the best week since March, kind of coming to life. That again, a sign of the non-recessionary thing happening. So we have a little bit of Dow theory at work. But let's start off not even by looking at the S&P. Let's look at the dollar index, because I think right now, with the Fed in focus, we have the dollar index here. I'm looking at trading view here, just so you know. But basically, if you look at the dollar index over a period of time here, going back to essentially when the Fed started hiking rates, had that big run up, and it's really been in this sideways range since. But I think the thing that's interesting here with the dollar index is that this is look at how it basically came here, and right around this level, it just broke through that, and then even here, it was kind of trying to hold for a short time, and now is breaking through this kind of you know level right here around 102 and a half even. So I mean, at this point, when you look at this, there's a lot of spaces here people can look to the downside. And I think right now when we look at the situation we're in, of people now kind of getting a greater sense of confidence about the Fed, and the potential for rate cuts, or at least one rate cut at the on September 18th. As we get more into focus on this, the dollar index and the knock-on effects of things like gold and silver and global stocks kind of mount. So I think it's important now to realize we're in a spot where this is an important form of intermarket analysis. You look at other things that can impact the market. At this point in time, a gradual crumbling of the US dollar is essentially something that is likely to be a positive in the background. For a long time, I said the 10-year Treasury was the most important chart to look at. Well, in some ways, the dollar index might become the most important chart to look at. The gradual kind of slide of the US dollar as we move toward that, September 18th and subsequent meetings. So I did want to mention that here. I mean, you really take a look at this, a move here to kind of the 100 level, people, might be looking at. But I think if you really look at a chart like this, I mean, this is dramatic, but I mean, something back closer to 90, not going to happen tomorrow. But the thing is, if you really look at it, you look at the environment we're in, the Fed and everything else, this actually could be a spot where, as much as the markets have, S&P has run, and there's been bullish sentiment in the overall risk markets. In some ways, this could actually make that more bullish. A gradual slide of the dollar index here, I think, is something here we have to realize is brewing in the background. Now let's turn to the S&P, because basically what we now have is, we have a level from back here, which is the kind of week that began, on July 22nd, and there's a level around 55.85. And in my view here, we're just kind of at a spot where we had a really dramatic drop and rebound. And I think the question now is just, you know, do we, you know, with this period in August and everything else, I think it's difficult to imagine, you know, a necessarily a continuation to new highs at, you know, this quickly after a drop like that. I think a lot of these things also come down to the Nasdaq, but from my perspective here, we're at a spot where we've come up to some resistance here, and we have the Fed minutes on Wednesday. We have Jerome Powell speaking at Jackson Hole on Friday. Then next week we have Nvidia earnings. So at this point here, I think the S&P, the key thing is that when it was had pulled back down here, we talked about the extreme oversold conditions that had happened, and we got that bounce. But now we're in a spot where when you look at it, people could see, I think, some potential here for some just kind of you know, drifting around near, you know, not necessarily anything that has any significant bearishness, but at this point in time, there's no really clear, you know, action necessarily, or opportunity clearly popping up to me in the S&P 500. If you look over the daily chart of the S&P 500, which is right here, you know, we do have now the 50-day moving average. We have this basically this candle here from August 1st. We looked at, and we're now positive on the month. You know, however, I do think, you know, there could be some potential for some chop downs kind of to this kind of level, or, you know, and it might not happen even this week. It could be next week because that 50-day will rise up. But the thing is that I'm kind of taking away from here is, if you look at the market, and we've talked about this a lot on market trends and other things, is that we've seen these tight consolidation periods. You know, the rally we had last week was the biggest rally in the S&P since back here at the you know, end of October, and then we had a tight consolidation and continuation. This market has had a tendency to have tight sideways consolidation and continuation to the upside. And I think right now, you know, that might be the way we want to be thinking. So if we see some pausing here, we're up for, I don't know, 7, 8 days straight, which is a pretty long daily winning streak. You know, Tuesdays, people might talk about things like turnaround Tuesday and all those things as potential sort of things to think about. But then the thing is if we kind of pause and stall here, you know, people might simply look for movement like we saw back here, these sideways, tight sideways movements with continuation. So I wanted to point that out. That is something this market has going for it. And I'll also go back here to this chart from the Federal Reserve, which is basically the amount of cash in money markets remains very elevated. It continues to go up. Now, this data is lagging. The last print on this was the beginning of July, but you know, they seem to release this data like a big chunk, and then they'll go weeks and months without updating it. But the key thing is, regardless of kind of where we are now, you know, it's not. I mean, it is the case that there's a lot of cash on the sidelines by various metrics. So that also puts us in a situation where, you know, you might look for a kind of sideways movement. Now, go to tradestation.com very quickly. Go to Insights. There's a blog we run. We do an article today. We have, first of all, some information in this article here about the S&P. I want to point out these last two because I do think they're interesting to look at. Last week, we talked about how the series of events that were coming, that did come last week, PPI, CPI, and then the retail sales, all of them kind of pushed direction in a positive sentiment in a positive direction, which is essentially the kind of thing we had discussed a week ago. Also, here on Thursday of last week, we talked about the fact that consumer sentiment was extremely low when you consider the economic conditions in place. Then it came out on Friday and it started surprising to the upside. So my sense here is that, or at least not my sense, but something I see as a possibility, as someone who's watched news for a long time, is that essentially I think we're at a spot here where we have been in an abnormal, you know, funk of negativity in the United States, politically, socially, and financially in terms of the market since really early 2021. People have been unhappy about inflation, a lot of other things. People were unhappy before that. I think when you look at, you know, just things like Trump's overall unapproval rating when he was president, he was surprisingly unpopular at the time for a country that was doing well economically. So the point is, I think people have not been happy about the country overall for a long time. And I think right now we're actually beginning to see that with inflation coming down and an election coming up, we could actually see a much longer term, you know, like kind of shift toward a positive sentiment. We outlined that in this article. You might want to check it out. But I think it's an important thing to realize, because you look at the cash on the sidelines, you look at things like, you know, just take a step back and think about it. Next week we have Nvidia earnings. After that, we have a possible slash probable slash potential, iPhone release. It's not been announced, but I mean, most people who follow Apple expect it around September 10th. So those are two issues where, Nvidia is the number three company in the market. Apple's the number one company in the market by market cap. So those are, catalysts for those. After that, we get a potential, move from the Fed. After that, we go into something like elections. We also saw upside surprises in earnings. You might want to really check this out. It's very interesting to actually look at these numbers on earnings. Remember, double-digit earnings growth are forecast for this year and for next year, and we're already ahead of pace on that. We're also seeing a lot of things happening that are kind of not just Nvidia. Look at Nike. Look at this thing with Starbucks. Look at this thing in Cisco. So you're seeing turnarounds kind of coming out of left field everywhere you kind of look. So there's a lot of things happening out here that are kind of catalysts in the market. So I want to just kind of point that out. Last week had some dramatic breadth. We basically had, it was pretty amazing. The biggest decliner in the S&P last week was Chipotle, down 5.5%. There were 63 companies up at least that much. So you basically had 85 or something percent of the companies in the index, 85% of the index members were up. The advanced decline line I'm going to show you here on this other TradeStation workspace right here, my MT breadth workspace. This is one I share with you guys if you want to come to Market Trends, 2 p.m. on Thursday. I'll give you this workspace. You can also download it from the previous. If you look at that, the thing I was, the article there with the blue one about sentiment turning. Anyway, there's a link to it in the zip file anyway. All-time high on the advanced decline line. This breadth workspace shows, the number of companies above the 20-day moving average in the S&P 500, 410 companies. That's basically, I mean, it was up around 400 something back here, right, when the market was peaking. But this is kind of, in the early kind of, stages of having bounced. And when you look at this before, when it tends to spike, it spikes and then it fades a little. But the fact is that historically, when this thing has a big spike up, it historically, especially if it's coming off of a low, it has been followed by continuation. So we have this breadth here, all-time high on the advanced decline line, even with the S&P below its all-time high. So I think these things are important to kind of keep in mind. Also today, S&P Global put out a note, and they were talking about how there was in August we saw the greatest stock market negativity in a year. We talked about also in an article a week or two ago about how the AAII sentiment got extremely negative. So what we're seeing here is we're seeing that people were really negative. And so again, this market, when you have people getting skittish really fast, the market rallies and it pulls back and they freak out and like, oh my God, I got to take profits. And then guess what? It comes roaring right back. That behavior is more consistent with the earlier parts of a bull market than the later parts of a bull market. So we're seeing, the selling is not sticking, and we're seeing the negatives morph into positives, or the negatives simply kind of fade or turn out to be nothing but phantasms, like this idea of a recession and the yen carry trade and all these things that for like 48 hours we thought were the end of the world, and they just dissolve, and then it comes back to Nvidia, Apple, small caps, Fed, oil going down, which today oil's getting slammed, and I can't even figure out why. So all these things, you put them together, and the bearish story refuses to come together. So I think it's just important to kind of realize. All right, now let's go into the Qs. Now, to me, the biggest issue here at the Qs is the Qs had, when something pulls back this hard, it often will see a period of consolidation. The volatility has to fade and it has to turn into tightness. And then that needs to often turn, kind of be the thing that comes together and then rallies again. So my bigger concern, not concern, but just observation about the Qs is this is a steep pullback. The Qs went back to levels from back here in April when the Russell did not, the S&P did not, the Dow did not. So the NASDAQ had a deeper pullback here. It's also happening at the halfway point through a year, and it's also happening at a point where the long-awaited explosion in the Russell did kind of happen. So, I think here we're at a spot where people have talked about this potential of there being a rotation to small caps and things like that, and that might be underway. And I think we have to kind of remember here that I'm going to get to the Russell in a second, But if you look here, there's a bunch of areas here going all the way back to mid-June. And I'm not even sure where exactly you'd want to look at the lines, but you can look at this zone. This was the high on one week, and it was the high the following week. But then you also, and it's right around the midpoint of this box is right around the high, the midweek of June here. So, or the close the midweek of June. So you just put them together here, and I think people might kind of look across here and see some potential here for the cues to kind of pause. So I want to just kind of mention that. Remember, this period of bigger swings may require bigger, longer period of consolidation. Now look at the Dow; it's pretty interesting. Now there's an article today or an analyst note. I think it's Evercore ISI. I'm not sure, but if you look, it's in the news, like on Yahoo Finance and stuff. There's a bunch of articles about McDonald's today. So what do we have? A potential turnaround in McDonald's. We have a potential turnaround in Nike. That's what people are saying. They're looking for things to happen with Nike. You had a very interesting earnings report in Cisco. You have, things like that in these large Dow stocks. So I think right now the Dow is kind of interesting. Of the big indexes, I think the Dow was the only one last week that closed at a record weekly close. So it's interesting to see here how the Dow kind of held above that level. So remember, the NASDAQ went back to levels from like April. This thing goes back to a level from June. That tighter kind of pullback tells you something. So this is one that, it can be, kind of a strange index. And people don't trade it that much. But in many ways, what this is kind of telling us is that this is also kind of an argument against growth, against the mega cap growth. Because even though they have mega cap growths in there, like they do have, Apple and Microsoft and stuff in the Dow, they also have Goldman Sachs, JP Morgan, the industrials. And I think right here this is kind of interesting because this is kind of consistent with a shift toward value, a shift towards cyclicals. But the big one here, let's take a look at the Russell here. The Russell is interesting to me because, first of all, it had this double bottom at the level from mid-June. What's also interesting about the Russell is you see this trend line, which I think we can say here that it's kind of broken this downtrend. Now, the other thing I think is interesting is this is one of the things I think is interesting about TradingView. I can do RUT/NDX, and it will just a quick ratio of the Russell against the NASDAQ. Now you can do this on TradeStation as well if you use the ratio indicator with two data input, but we'll do this quickly on TradingView. And I think we have to realize here is that this was an epic historic rally that we saw in small caps after the rally in July, after that CPI report that lifted the market here. And this was a big move. And now look how we're holding a 50% retracement of the move. Now remember, this is the ratio of the Russell against the NASDAQ. It had this big surge and it's holding the 50% retracement. So for me, this is kind of interesting. If people are really looking at this historic kind of like existential, life-changing, thing that's supposed to happen in the small caps, because people have been talking about this. They've made this argument. The small caps are undervalued by all these measures, and it's been this like basically back and forth debate of between like the NASDAQ and the Russell for a long time. So I just think it's important to realize that if we really get a sense that this thing is happening in the Russell, there is potential for people to kind of pile into it, because I think it's been Lucy in the football. We've been burned many times, but if people start to believe it's real, it is something that has the potential for people to pile into, especially with the potential for Fed cutting, rates, especially for something like a cyclical recovery in the economy that at this point in time people are not really thinking about. The bank earnings have been strong. Things like that we have to realize, they were surprising in terms of better than expected or smaller than expected loan losses, improving that interest margin. A big surge in mortgage refinancing activity recently. Well, when you refinance your mortgage, you're paying fees to the bank just for doing that. They're not doing that out of the kindness of their own hearts. People are paying money for mortgage refinancing. Rates come down. All these things in general can be positive for things like financials and positive for small caps, in general. So I think it's important to realize here that this has been a long-awaited move. The Russell has lagged the NASDAQ for a long time, and it doesn't have to go back to where it was. We could simply have a period here of a quarter or two of a catch-up or some kind of mean reversion that could actually be interesting. So I think right here, the Russell does remain an important thing to be looking at. So that's just something that, I got to put on people's radar here using this ratio. between RUT and NDX on a weekly chart on TradingView. Now I'm going to go to TNX, which is a 10-year treasury. And, from my perspective here, this is something where when you look at this chart, it looks kind of like the dollar index. It's like not anything maybe that people are, obviously trading, but it gives us, it's an intermarket. It's kind of like Charles Dow. He used the Dow transports as intermarket analysis. I use the transports a little. It's lost a lot of relevance, but I look at the VIX, I look at the dollar index, and I look at the 10-year treasury. Those are the things I look at mostly for intermarket analysis. And if you look at these here, this looks kind of like the dollar index where, the uptrend is broken, this weekly level here that's lower. So I think right now when we look at this, people might be kind of thinking of something of a slow, gradual bleed back under 3.5 toward 3.25. No rush on it or anything. But the thing here is that it's at a spot where the upside thrust that we had in the yields that we saw back here in 21, 22, this thing is structurally really no longer evident on the charts, at least, from the sort of things I'm looking at. So I want to mention here, people looking at this might actually see the potential for further downdraft in the yields. Okay, now materials, XLB. This is interesting because we have this falling trend line here that we're trying to break. We have a higher weekly low right here. And so I think right here, what's interesting about something like this is with the idea of a dovish Fed, with the idea of the cyclical trade, something like here, a tight range. We've been talking last week about the industrials. We're going to get to it. But this thing kind of looks like the industrial stock, the industrial chart, which is breaking out right now. Looks like the financials, which is breaking out right now. What is materials? It is not tech. It is the same thing in many ways as industrials and financials. These are cyclicals. People now could be looking for those kind of traditional, old economy plays to kind of kick in and play catch up. And I think that's an important thing to realize is that we can go through that process here. And something like the materials could be, one of those areas that people would look to. So just this higher low here is potentially interesting. If you look really quickly in the daily chart of XLB, we also see here that we're kind of back above that 50-day moving average. And this might be something here where just being above the 50-day with this range, it's kind of level here, right on this 88 level, this low, lower low, higher low, kind of a basing pattern above the high from back here in December. This is something with the 200-day simple moving average catching up and a big surge here in the improvement of the relative strength. The 21-day lagging relative strength actually improved in this. It's starting to outperform. So this is something here I think also does not get a lot of attention, but gold and silver miners have been really exploding higher here. All those things are kind of pushing in that direction. Metals are also doing pretty well today, the industrial metal stocks. So this is one here. I think we look at XLB. This might be something that people look at as a sort of Fed play, also weak dollar play. All right, now XLC Communications. This of the three growth focused sectors has held up the best, had the smallest pullback. It only pulled back the levels from May here. And, from my view, when you look at something like this here, the fact that it had such a tightness here, it held, look also how this low from last week, it held the close from the preceding week. So from my perspective here, you look at something like XLC, this might be something here where, the people see potential for this one to be the continuation to the upside over something like tech, which I think is important to realize that, that the overall XLK, as we're going to get to, looks a lot like the Qs. It was very volatile and sloppy. XLE, now this is something here where it kind of had a false breakdown and snapping back. But, I think it's interesting here with the idea of there being a weak dollar, stronger economy. There's an argument in favor of energies here. When you look at this, from my perspective, it has some potential to drift up here, all the way kind of toward, 94 area, these old highs. But I got to very quickly just show you the oil chart because I'm going to just do 4-hour bars on this. Something is happening here with crude oil. I've been trying to figure it out. But I think right now China's weak, and it looks like we're gonna, ceasefire or something. I'm not sure exactly. Not an expert in geopolitics, but the forces right now in energy. We've talked about it a lot. The fact that there's increased supply, weakness from China. Next year, OPEC goes into basically, every man for himself. in terms of these countries do not want to be basically being nice to each other. They all want to pump more oil. And so I think right here, you look at something like energy. But again, what does that mean for everything else in the market? If energy is weak, that is a positive for inflation, and it's basically good for everyone else. So energy here, I'm going back to the weekly chart of this. From my perspective, it's kind of trying to chop up and stuff here. But this is something that if there is a sector where people might be looking for the most vulnerability, this might be the one. We also had some news here in the energy stocks of I think APA is doing some stuff of selling assets. So we're going to see some things here of like some strategic things kind of, shaking the trees a little. But I think also right now you look at energy of all the sectors we're looking at structurally, this one has the most kind of issues. All right, now financials on the other hand. I mean, basically, this little arrow means that it closed at a record weekly. I put a little arrow to show that it had a record weekly close. One of the patterns we looked at is when things close the week at a high, there has tended to be follow through. We're seeing that here in financials, and essentially here, I think that we're in a spot where everything I said about things like net interest margin, cyclical part of the economy. We talked about how a stock like Moody's MCO has been a really good canary in the coal mine to show that there is that demand for financial intermediation, for Wall Street underwriting stuff. All those sort of things have been coming together for the financials here. And I think, again, if you're rotating away from NVIDIA, you don't have to go buy like crazy high volatile speculative stocks. There are other stocks out there that are kind of blue chips, and financials are one of the most clear places for people to look. Wall Street has been in a semi-recession for a long time in terms of deal making and stuff like that, and a rate cutting environment and things like that, a small cap strength environment. Those things translate through into positives for financials. So right here, in my view, financials are just in a spot where they basically held this we had a weekly low before the sell-off week, and then they held above that low. So they made this higher weekly low last week, and here they are up here. I mean, this is actually the little candle right now. They're all the way up here. So I wanted to just kind of point that out. This is an interesting pattern, but it's also interesting to look at that in terms of XLY. We did a trading XLI. I'm sorry, industrials. We did a trading view idea on this one. Basically, it was pushing up the close of the all-time high. Last week, we talked about this tight range between 120 and 126 on the industrial ETF. Again, a cyclical, something that had tight sideways consolidation that it now seems to be escaping. And from my perspective, this is something here that people look at something like the Nasdaq. They look at the tech, which I'm going to show you right here. These things have not gotten back to their highs. They've had these big volatility swings. Then you look at stuff like XLI, XLF, Dow Jones Industrial Average, even the materials to a certain extent, they've been tight. And that also is something where less volatility is often associated. I mean, you get the violent rebound like we saw in the NASDAQ last week, but often you get that violent rebound and then there's not enormous amount of continuation after that. Instead, you just get, it's still below the old highs, and then other stuff breaks out and kind of runs. And so I think we have to be kind of looking for that potential. I mean, look at the areas that are doing it. Financials and industrial seem to be manifesting that the most. Okay. XLP, I mean, boring consumer staples, but we also saw this pattern kind of where it had been pushing the closing highs, and now here it is basically pushing back. For me, this is something here where it's a kind of quiet breakout here happening in a name like the consumer staples. The real estate investment trusts here are also in an area where they're just squeezing above. And this looks like a bullish ascending kind of triangle, lower highs essentially going up. It's made higher weekly lows for wow. Many look all the way back here from like June. Every weekly low, I think, has been higher. Pretty interesting in the XLRE. This also benefits from lower interest rates. So I want to point that one out. We had multiple inside days here. See, this thing shows us the inside weeks. I'm sorry, not inside days, but inside weeks. So we have this level here, this old resistance that we're pushing against, this high from back here in early 2023. So it's kind of interesting to see that. I should actually draw that level here on the chart. I was looking at it, but I had not drawn it. That was a high at 42.21. Just there we go. Good. I'm going to save that level. but it looks like here there's something that people might be looking at here as a potential sort of for continuation to the upside. Utilities also here are in a very similar pattern. Utilities have some interesting growth things underway because of the demand for power because of AI, also because of interest rate cuts. They're not just necessarily a safe haven at this point in time. There's other things happening in utilities. We talked about what's happening in healthcare, along with financials. In some ways, healthcare are one of those kind of no-brainer, mega, large cap, institutional grade sort of sectors that people can be looking to put money in, things like United Healthcare and these big health insurance companies, these Johnson and Johnson, names like that. It's really interesting to see this quiet breakout in something like the XLV. We had talked to these higher lows that we're building. We looked at this level here on 148 that it held. It fought its way through it. And so it's pretty interesting, I think, to see this kind of this quiet, big, kind of just gradual breakout in XLV. So that's interesting. And we saw that same thing. They closed at a record weekly close last week. And then the XLY, this is something here where this looks a lot like the consumer discretionary. It looks a lot like the XLK and a lot like the Qs. Big, wide swings here. And I just want to mention this 185 level that we're now sitting at actually goes back to February. And so again, I think you can look at this and you could see potential resistance at a lot of different spots here. You could look at resistance somewhere at these highs as well, or even down to this low here. So I think when you look at like XLV, it's also in a very kind of tortuous sort of situation where it has now a spot where people might see we're getting closer to the resistance on the upside, and there's a lot of space to the downside. So from a risk reward perspective, people might see we're at a spot where things are getting kind of close on, we're pretty close to the upside. And it might actually be more of a risk of looking for pullback. So I wanted to just kind of mention that. So the overall thing I want to mention is financials, industrials, consumer staples, healthcare, and the Dow Jones Industrial Average had record weekly closes. With the potential for a weak dollar, we could see some, there is that potential for some acceleration in things like the materials. We seem to be, to a certain extent here, of a pretty significant thrust of breadth and participation. The advanced decline line making new highs when the market has not yet done that is a sign of that sort of strength. So people talk about these sort of, small caps, equal weighted, mid caps, financial, industrials, value, all those things. There's a growing evidence that that trend is taking hold. Nonetheless, we should not forget Nvidia reports earnings next week, and then Apple's on deck with its expected iPhone in early September. So you put those things together. This is really a market I think we have to realize there's a lot of potentially positive catalysts out there. And even though it's run a lot, when you really take a step back, a lot of the forces that are happening suggest that, this process of things kind of improving may not be done, especially when you consider how negative sentiment has been. And we saw that in the consumer sentiment. We saw it in S&P Global's investor sentiment index. We saw it in the American Association of Individual Investors. All those showed significant negativity at a time when the Fed's getting ready to cut rates and earnings are surprising to the upside. And breadth is improving in the market and cash is at record highs in the money market account. So those are some things I wanted to kind of put out there for you guys. Remember, we will be back with market trends Thursday afternoon at 2 p.m. Hope to see you then. Thank you very much and have a great day.